Here's a shocking fact. 63% of Americans can't cover a $500 emergency, but you're not going to be one of them. Today, we're exploring 5 financial milestones that'll set you apart from the crowd and secure your financial future before you turn 40. Listen, hitting these financial goals before 40 isn't just about money. It's about setting yourself up for success and creating a life with more freedom and choices. Trust me, I've been there, I've done it, and I know how important this is. In this video, I'm going to share 5 financial goals that will change the game for you. These aren't just random targets, they're practical steps that will give you real control over your future. So are you ready to take charge of your finances and set yourself up for long-term success? Let's dive in and see how you can make it happen too. Now, you might think that saving money is always a good thing, but what if I told you that saving without purpose could actually lead to unhappiness? This brings us to our first financial milestone, creating your life blueprint. It might sound strange to start a financial journey by not talking about money, but trust me, this is crucial. Your life blueprint is like a roadmap that guides all your financial decisions. It's about understanding what truly matters to you and aligning your money with those priorities. So, how do you create this blueprint? It's simpler than you might think, actually. Grab a piece of paper and ask yourself some key questions. What brings you joy? Do you prefer the flexibility of renting or the stability of owning your own home? What kind of challenges do you enjoy tackling in your work or personal life? Do you want to have the freedom to play paddle whenever you want, like me? Sorry, I'll stop talking about me for a second now. Don't worry about money constraints for now. Just focus on what truly makes you happy. This exercise isn't just about dreaming big. It's about gaining clarity on your values and what you want out of life. Once you have this vision, you'll find that making financial decisions becomes much easier. You'll know exactly why you're saving or spending, and you'll be more motivated to stick to your financial goals. Now, I'm not saying you should throw caution to the wind and spend recklessly. The key is to finding a balance between being financially responsible and enjoying your life. This balance is different for everyone, which is why your personal life blueprint is so important. One practical step to help you along this journey is to track your expenses. You might be surprised at what you discover. Maybe you're spending more than you thought on things that you don't really align with your life vision. Or perhaps you'll find areas where you can cut back without feeling deprived, freeing up money for the things that truly matter to you. Remember, creating your life blueprint isn't a one and done deal. It's an ongoing process. As you grow and change, your priorities might shift, and that's okay. The important thing is to stay aware of what you value most and adjust your financial decisions accordingly. By starting with your life blueprint, you're setting yourself up for long-term success. You're not just blindly chasing a number in your bank account, you're creating a life that's truly fulfilling. And when your financial goals are aligned with your personal values, you'll find it much easier to stay motivated and make progress. Now that you've aligned your finances with your values, let's talk about a powerful tool to make it all happen. What if I told you that there's a simple rule that could transform your entire financial life, and it only involves remembering 3 numbers? This method has helped countless people take control of their money, and it might just be the key that you've been missing. Let me introduce you to the 50-30-20 rule. It's a straightforward guideline that can help you manage your money more effectively. Here's how it works. You allocate 50% of your income to needs, 30% to wants, and 20% to saving, and it's that simple. Let's break it down with an example. Say you earn $6,000 a month. Using this rule, you would set aside $3,000 for needs like rent, utilities, and shopping. Then $1,800 would go towards wants, things like entertainment, dining out, or that new gadget you've been eyeing up. Finally, $1,200 would be dedicated to savings and financial goals. Now, I know what you're thinking, Alan, that sounds great, but my situation is different. And you're absolutely right. The beauty of this rule is its flexibility. It's not a one-size-fits-all solution, and you can adjust these percentages based on your unique financial situation. The key is to use it as a starting point and tailor it to your needs. The more aggressive you go now, for example, you go 25, 25, 50, the quicker you can enjoy life on your own terms and financial freedom. The choice is all yours, my friends. One of the most crucial aspects of budgeting is tracking your spending. It might seem tedious, but trust me, it's a game changer. The app I would recommend is Emma, which can plug into all of your bank accounts within a matter of minutes and can create automated reports based on your spending, set up alerts so you don't reach your spending limits. I popped a little link in the show notes below so you can check this out. I met up with a friend recently who started using the Emma app, and they were shocked to discover they were spending £800 more each month than they thought. That's a huge difference, by the way. By simply becoming aware of their spending, they're able to make significant changes and improve their financial situation, and we're able to save an additional $10K per year. And if we invest this for 40 years at 8% interest, they would have a mammoth $5 million saved, all because they decided to use Emma. Another tip that can make budgeting a lot easier is to set up automatic transfers to your savings account as soon as your paycheck hits. This way, you're paying yourself first and ensuring that you meet your savings goals before you have the chance to spend that money elsewhere. Remember, budgeting isn't about restricting yourself. It's about giving yourself permission to spend on the things that matter most to you while ensuring that you're also preparing for the future. It's all about balance. As you work on your budget, keep in mind that it's not set in stone. Your financial situation will change over time and your budget should change with it. Make it a habit to review and adjust your budget regularly. This will help you stay on track and ensure your budget continues to align with your goals and current circumstances. Here's a little quote from me. What gets measured gets managed. By tracking your spending and sticking to a budget, you're taking control of your financial future. Now that you've got a handle on your budget, let's talk about something that can make or break your financial future. Did you know that a seemingly small difference in your credit score could cost you a fortune over time? Imagine losing out on your dream home or paying thousands more in interest, all because of a few digits on your credit report. That's right, we're diving into the world of credit scores, and trust me, this is a game changer. Your credit score is like a financial report card that banks and lenders use to decide whether to trust you with their money. It's a 3-digit number that can open doors to amazing opportunities or slam them shut in your face. Let me give you a real-world example of just how much impact your credit score can have. Picture this, you're ready to buy your first home, a $350,000 property with a top-notch credit score, and you might get a mortgage of say 4%. But if your score is just a bit lower, you could be looking at a 5.5% rate. Now that might not sound like a huge difference, but over 30 years, it adds up to a whopping $113,000 in extra interest. That money could have been used for investments, travel, or even starting a business. So how do you build this credit fortress? It's all about responsible credit use. One of the biggest factors is how you handle your credit cards. Aim to pay off your balance in full each month. This shows lenders you're reliable and can manage credit responsibly. Another tip, keep your credit utilization below 30%. That means if you have a $10,000 credit limit, try not to use more than $3,000 at any given time. Now, you might be wondering, what is a good credit score? Well, if you want access to the best rates and benefits, you're looking at a credit score above 750. That's your target, but don't worry if you're not there yet. Every step you take to improve your score can make a big difference. Here's something many people overlook: checking your credit report regularly. And you can do this for free once a year at annualcreditreport.com. It's like giving your credit health checkup. You want to catch any errors or suspicious activity early before they can do serious damage to your score. Remember, your credit score isn't just about loans and credit cards. It can affect your ability to rent an apartment, get a car loan, or even land a job. Some employers look at credit reports as part of their hiring process. So maintaining a good credit score is about creating more opportunities and freedom in all areas of your life. Think of building your credit as a long-term investment in your financial future. It takes time and consistency, but the payoff is huge. By managing your credit responsibly, you're not just saving money on interest rates, you're opening doors to better financial opportunities, increased credit limits, and more flexibility in your financial decisions. Here's a pro tip from me, guys. If you're just starting to build credit, consider a secure credit card. It's a great way to establish a credit history without the risk of racking up debt. Use it for small, regular purchases and pay it off each month. Over time, you'll see your credit score improve and you can graduate to unsecured cards with better benefits. I've linked a whole host of cards in the show notes below. Now that you're on your way to building solid credit, let's talk about growing your wealth. Did you know that a simple investment strategy could turn $1,000 into over $1 million? It's not magic, it's maths, and it's a secret that the wealth you've been using for centuries. Let me tell you a story that perfectly illustrates this concept. Imagine an emperor agreeing to pay the inventor a chess with grains of rice. What's the catch, you say? The amount doubles for each square on the chessboard. By the 30th square, the emperor owed over 1 billion grains of rice. Warren Buffett is the grandfather of investing, and he once said, "Money is like a snowball. The important thing is finding wet snow and a really long hill." This highlights how compound interest builds wealth over time, and a vast amount of Buffett's wealth came after the age of 65. So what exactly is compound interest? It's when you earn interest not just on your initial investment, but also on the interest you've already earned. It's like a snowball rolling down a hill, getting bigger and bigger as it goes, as Buffett alluded to before. The earlier you start, the more time your money has to grow. Let's look at a practical example. If you start investing at age 20, putting away just $200 per month, by the time you're 65, you could have over $1 million. But if you wait until you're 30 to start, you need to invest more than twice as much each month to reach the same goal. That's the magic of starting early. Now, I know what you're thinking, Alan, this sounds great, but I don't know the first thing about investing. Don't worry, I've got you covered. One of the easiest ways to start is with index funds. These are like a basket of stocks that represent the whole market, giving you instant diversification. The best part, you can pretty much set it and forget about it. Here's a pro tip: automate your investments. Set up a monthly transfer from your bank account to your investment account. This way, you're consistently investing without having to think about it. It's like paying your future self first. But what if the market crashes, you ask? Well, that's where the beauty of long-term investing comes in. When you start early, you have time on your side. Market ups and downs tend to smooth down over the long run, and historically, the market has always trended upwards. Remember, you don't need a lot of money to start. Even small amounts can grow significantly over time. The key is to start now and be consistent. Every day you wait is a day of potential growth lost. Now, before you jump in, make sure you have a solid financial foundation. This means having an emergency fund in high-yielding savings accounts. This gives you a safety net while your investments grow. I've listed my top 5 savings accounts from the US and UK on the screen now and linked them below in the show notes for you as well. Investing might seem intimidating at first, but it's one of the most powerful tools that you have for building wealth. It's not about getting rich quick, it's about building wealth steadily over time. And the best part, your money is working hard for you even while you sleep. Now that we've covered growing your wealth, let's talk about protecting it. Did you know that 40% of Americans can't cover a $400 emergency expense? Here's how you can make sure you're never part of that statistic. Let's talk about establishing your financial safety net. I'm going to share with you a powerful strategy that can give you peace of mind and protect all your hard work. It's called an emergency fund. It's a game changer when it comes to financial stability. An emergency fund is essentially a stash of money set aside to cover unexpected expenses or financial emergencies. Think of it as your personal insurance policy against life's curveballs. The general rule of thumb is to save enough to cover around about 3 to 6 months worth of living expenses. This might sound like a lot, but trust me, it's worth it. Let me break it down for you with a simple example. Say your monthly expenses total $3,000 per month. This includes rent, utilities, groceries, and other essentials. In this case, you'd want to aim for an emergency fund between $9,000 and $18,000. That is your target range. Now, I know what you're thinking, that's a lot of money, and you're right, it is. But here's the thing, you don't have to build this fund overnight. It's all about consistency and making it a priority. One of the best ways to build your emergency fund is through automation. Set up an automatic transfer from your bank account to a separate savings account each payday. Even if it's just a small amount to start with, it adds up over time. And by automating this process, you're making sure you're consistently saving without having to think about it. Another strategy is to look for areas in your budget where you can cut back. Maybe it's that streaming service you really use or those daily coffee runs. Small changes can make a big difference when it comes to building your emergency fund. Here's something crucial to remember. Your emergency fund is for actual emergencies only. It's not for that new gadget you're being eyeing up or spontaneous weekend getaways. It's there to protect you from life's unexpected events like a sudden job loss, a major car repair, or an unexpected medical bill. Having a solid emergency fund does more than just provide a financial cushion. It gives you peace of mind and reduces stress. Imagine how different life would be if you knew you could handle any financial surprise that came your way. That's the power of an emergency fund, my friends. But the benefits do not stop there. An emergency fund also gives you the freedom to make better financial decisions. Without the pressure of immediate financial need, you can take your time to consider all your options and make choices that align with your long-term goals. For example, let's say you're not happy in your current job. Without an emergency fund, you might feel stuck, afraid to make the change because you can't afford any gap in your income. But with a solid emergency fund in place, you have the freedom to explore more opportunities, maybe even take some time off to upskill or start your own business. That's the kind of freedom and flexibility an emergency fund can provide you. Remember, building your emergency fund is a journey. It might take some time, but every dollar you save is a step towards greater financial security. Start where you are and with what you have. Even if you can only save a small amount each month, it's better than nothing. As your income grows or your expenses decrease, you can increase your contributions. And here's a pro tip from me. Consider keeping your emergency fund in a high-yielding savings account. This way, your money can earn some interest while it's waiting to be used. It might not be much, but every little bit helps. All right, let's recap the 5 financial milestones we've covered today. Creating your life blueprint, mastering budgeting, building your credit fortress, harnessing compound interest, and securing your financial safety net. These aren't just arbitrary goals, they're stepping stones to a secure financial future. The key takeaway? Start early and stay consistent. Every small step you take compounds over time, creating a massive impact on your financial health. Remember, it's not about perfection, it's about progress. So which milestone will you tackle first? Maybe you'll start tracking your expenses or open that investment account that you've been putting off. Whatever you choose, take action now. Your future self will thank you for the financial decisions you make today. Trust me, the sooner you start, the more options of freedom you'll have down the road. As always, guys, smash a like, ring that bell, and let me know in the comments below which steps you'll be taking today. And if you look on your screen now, you'll see some of my other videos which I think you'll find useful, and I'll see you all in the next one.